Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. So let's start by talking about change number 1, changes made in accounting estimates. And these are going to be changes made by company management to estimates that they previously made. You might be thinking, what? Why are we estimating anything? Shouldn't the financial statements be definitive numbers based on fact? Well, certain figures within the financial statements aren't always going to be entirely quantifiable. So when reporting the financial statements, management is going to make an estimate. Okay, so great example is always going to be the useful life of a fixed asset. Okay, so addressing our 2 questions. Question number 1, the how. So the first question is, how is this change being made? Maybe it requires that we recalculate that depreciation expense. But we're going to star question number 2, the when. Okay, so this is the more important question. And when you think about the word estimate, specifically when studying for the FAR exam, your buzzword is always going to be prospectively. So in your brain, these 2 words should be joint at the hip. All right, so before we memorize words, let's understand what they mean. The definition of an estimate is a verb, and it means roughly calculate or judge the value, number, quantity, or extent of. And now let's define the word prospective. This is an adjective, and it means expected or expecting to be something particular in the future. Okay, so when you see how these words sort of blend together, let's take a step back and think about how they tie back to the material. So when companies experience changes in accounting estimates, they will prospectively change their estimates in the financial statements. So that means that the change will be made in the current year and all future years thereafter, right? The word future is within the definition of prospective. Okay, so at this point, we've talked a lot about how depreciation expense and changes to the fixed asset's useful life would be an example of a change in estimate. But that's not the only example of changes in estimate. There are other examples that you could see on the exam. Okay, so some of those other estimate change examples consist of warranty obligations. As we learned in previous modules, warranties are often going to be estimated. If there's a change in that warranty obligation estimate, that change is going to be made within the financial statements in the current year and all future years. Okay, so same goes for estimates of uncollectible receivables, aka bad debt expenses. All right, so because we sell something on credit doesn't necessarily mean that we're going to collect everything. So we need to estimate the portion that we don't think we're going to collect from these receivables. That estimate is often made based on prior historical information, right? How much did we collect in the past? All right, but it's going to fluctuate sometimes. And the one we're going to go ahead and star, again, is changes in useful life of fixed assets. This is an example that they love to test. All right, we're going to come back to that at the bottom of this list as well. Next one we have is obsolete inventory. How much of our inventory is obsolete is often going to be estimated. Okay, so pending litigation, what the result of the pending litigation settlement is to be determined. We often need to estimate that as well, right? How much do we expect to receive from this lawsuit? How much do we expect to pay from getting sued? All right, and the last one is something that we need to keep in mind. Changes in accounting principle that are inseparable from a change in accounting estimate. Okay, so when we talk about changes in principle, which we'll get to more in just a second, we're going to be talking a lot about changes from one GAAP methodology to another GAAP methodology. All right, so changes in methodology are going to be changes in accounting principle. But certain changes in methodology are inseparable from changes in accounting estimates. Okay, so sometimes this is referred to as impracticable. If it's impractical, then we need to go ahead and record this as a change in estimate. All right, so this is going to, again, consist of changes in depreciation methodology and changes in inventory methods to LIFO. All right, so that is something you need to memorize. Alrighty, so now let's bring our guys over from the company Prospect Future Construction. Now, because Prospect Future is a construction company, they naturally have a lot of fixed assets on their books. They have a lot of machinery, they have a lot of equipment that will eventually get depreciated with time. All right, so Reggie is the CFO of the company, and thus one of the company team members that is primarily responsible for presenting the financial statements to its financial statement readers. So due to the nature of the business, Reggie will need to estimate machinery's useful life. And now keep in mind, although Reggie has been in the business for a long time and has a good idea of how long these assets will generally live, how long they will be usable, a lot of things can change. Maybe some unexpected projects came up that needed to use the assets, and therefore some of this depreciation might have been accelerated. Okay, but bottom line, if a change in estimate is made, that change will be made prospectively. So that means, again, that the change in the financial statements, the when, will be made in the current year and in all future years. Right, so we're thinking about the word prospective, and we think about prospect in prospect future. We're going to be making the change this year and all future years. We're never going to be going backwards, all right? Never looking at prior years. So when you're thinking prospect future, you're thinking prospectively, this year and future years. Alrighty, so boom, let's take a look at the example now and really break this out to give you that aha moment. On January 2nd, year 1, Prospect Future Construction Inc. purchased 5 brand new excavators in the current year to be used in its construction projects for $1.2 million. In year 1, Prospect Future estimates that the machinery will last for 15 years. At the beginning of year 3, the company determines that the machinery will now likely only last for a total of 10 years. Okay, so this is key. Whenever you see the word total in a change in estimate, we got to circle it, underline it, whatever we need to do, because the total of 10 years is going to be important. All right, so let's continue reading. Therefore, Prospect Future makes a change in its accounting estimate while using a straight line depreciation method. The machinery has a $0 salvage value at the end of its useful life. We're going to determine how Prospect Future would depreciate its assets considering the change in accounting estimate. All right, so taking a step back, we purchased this at $1.2 million, and we think these assets are going to last for 15 years. So in year 1, the depreciation expense is going to be $80,000. In year 2, another $80,000 is going to be the depreciation expense. We're taking $1.2 million and dividing it by 15 years. But at the beginning of year 3, we made this change in the estimate, right? We're now saying that we think all of these assets will only last for a total of 10 years, not 10 more years, a total of 10 years. So we already depreciated them for 2 years. That means that we have 8 years remaining. Okay, so we're going to take our total net amount after the accumulated depreciation up to this point. So 1.2 million minus year 1 depreciation expense of 80,000 minus year 2 depreciation expense of 80,000. So after reducing the 1.2 million by the 160,000 accumulated depreciation up to this point, we now have a new depreciable base of $1,040,000. Okay, so we're now dividing $1,040,000 by the 8 remaining years. So what that means is the depreciation expense from year 3 through year 8 will be $130,000 per year. Right? The new depreciable base of $1,040,000 divided by the 8 remaining years to equal our 10 total years will be $130,000 per year thereafter. Okay, so the change was made at the beginning of year 3, so that's going to be the current year and all future years, right? This is made prospectively.